Hi guys, welcome back to the channel. If you're new, please consider subscribing. That's the only way that you're going to get notified when we post future videos. Like this video, give it a thumbs up. That's the only way, that's the only thing I'll ever ask you to do. You do not pay for anything. You do not pay for forex robots, forex systems, indicators, and stuff that you can find from the blogs. The links are in the description box below. Visit those blogs and see if you cannot find what you're looking for. If you have comments, if you've got thoughts, if you've got topics that you want me to make videos on, leave them in the comments section below and I'll try to make videos answering questions. Today we are talking moving averages. We're going to do a series of videos on how to use some of these common indicators, how to best use them, how to understand them, how to understand these indicators, and how you can use them in your own trading to make more money, to give you that extra edge in the forex markets. So let's get into today's video. Moving averages. If you're on your MetaTrader, basically you can find your moving averages from the indicators section. Trend, this is where you find moving averages, and you can basically set them to anything that you want. So here you have a choice of between simple and exponential and smooth and line weighted moving averages. The popular ones you will see here that I had an exponential one, which is called EMA. It's abbreviated EMA, exponential moving average, and you have the simple one, which is abbreviated SMA, which is the simple moving average. Those tend to be the most popular versions of moving averages on any chart. People seldom use the smooth and the linear weighted ones. These two, the first two, tend to be the most popular ones. The difference between them, let's start with the simple one. Let's plot the simple one. There is the simple moving average, and let's plot in an exponential one, exponential moving average. So you see the difference there. The blue one is the simple moving average, and the maroon one is the exponential moving average. Both are set at period 50. We are on a 30-minute time frame, so they are calculating according to 50 30-minute bars. So what's the difference between the EMA and the SMA? The difference basically is just a speed of analysis. When it comes to the simple moving average, it's the slower one. It's slow when it's doing its calculations. But when it comes to the EMA, it's faster when it's doing its calculations. That's why you can see the differences there, because the EMA is faster and the SMA is slower. That can actually mean a difference in your trading. Some people prefer using the EMA. Some prefer because they are looking for quick signals. They are looking for quick signals in the market, and some people prefer the SMA. It's slow, but its signals are more reliable. What do I mean? What it means is, because the EMA is faster, it also means that it's susceptible to giving out false signals. When things suddenly change. It's susceptible to giving out false signals. So fast is not always good. The downside of the SMA, we said it's slow. So whereas a person using the let's see if we can get to the end of this chart. Well, yeah, they look like they are the same, but there are instances like this. You can see that the EMA already gave the signal to sell, and the person had to wait for the next candle for the SMA to confirm the sell. So the advantage of the EMA is generally that you get your signals earlier than the person who was trading with the simple moving average. However, we said the EMA sometimes, because it's faster, it's quicker when it gives its signals, it tends to be caught out a lot by sudden market movements, by sudden checks in the market. So faster does not always mean that it's going to be making more money than the SMA. The SMA is slower, but you can rely on its signals because it's slower. So it's waiting for all the market conditions before agreeing to a signal. But so that's generally the difference between the EMA and SMA. Those are the most popular moving averages that you find out there. Of course, people will try to use the linear one and the what else, the other one, but the popular ones are SMA, EMA. So how do you use these moving averages? How do you use these moving averages in your trading? If you are a day trader, you are a scalper, or you are a day trader, you trade the day, and at the end of the day you have closed out your positions. Here are some of the moving averages that you probably need to have on your charts. I'll start with trend moving average. What you probably need to have is a 9. Okay, keep it exponential, or you can change it to simple. You decide what you want to do. Let's start. You can have a 9 which sort of hugs price. You can see the 9 moving average, 9 period moving average sort of hugs price. You can make it a 9 or a 10. You can make it a 9 or a 10. It's up to you. Then this is the faster filter, because the moving averages, they are acting as filters. They're acting as filters for price. So this is the faster filter. Then a sort of medium filter, you want to have a 20 or 21. Let's make it 20. You can keep it exponential, since we started with exponential. With 20 there, you can see that you are slowly building up a picture of what price is doing. This is a 15-minute chart. If we flip over to the 30-minute chart, you can see what's happening there. If we flip over to the 1-hour chart, you can see what is happening there. So let's go back to the 15, because I think day traders enjoy or love using the 15-minute time frame. Then for the long-term trading, long-term filter, what you want to do is to insert your 50. I'm just keeping it exponential because I started with exponential, but you can play around with maybe put it somewhere there. You can play around with whether you want exponential or simple on your 9, on your 20, or on the 50, or you can mix them up, or you can keep them as one type. It's basically up to you. So you can basically see that you have a foundation of a strategy here. The 50 acts as your long-term filter. It kind of is the bias. It kind of gives you the bias of where you should be going. As long as price is above the 50, you are just looking for buys. You are not looking for sales. As long as price is above the green 50 moving average, you are only looking for buys. And as long as price is below the 50, you are looking for sales. As simple as that. And now when it comes to these other faster filters, that's where when price comes back to the 50 and you're not sure whether it's going to go up or whether it's going to go down, but you're waiting for this filter. When it goes down here, you know it's time to sell, and it did sell. And then again you wait for price to pull back into the 50, and when these lower filters give you the signal, you sell. So that's generally how you are going to be trading with this. For buys, this tells you is be ready to buy, and as soon as price pops up above the 50, then you start buying. Generally you want to aim for 10 or 20 pips when price crosses above the moving average. 10 or 20 pips, like what happened there, and you close your trade, or you can wait for the cross. It's up to you. Well, you can wait for the cross to close your trade, but generally I would say aim for 10 to 20 pips and close your trade. Each time you are doing that, you are coming out with a profit. 10 to 20 pips. Of course, the strategy is not foolproof. Here we had about 65 pips. Of course, there are instances like this. Instances like that. I'm looking for a shape. Instances like this. These are instances where you do not trade. Do not trade instances like this. Price is in consolidation. You can see what's happening here. So there's no definite direction here. So you do not trade instances like this. You are basically looking for instances like this. Instances like this one, you do not. I'm trying to move this. You don't trade instances like that, because there's no clear direction there. When the moving averages are so close to each other, they are clustered to each other, don't trade instances like that. Don't trade instances like this. You want the moving averages to start moving away from each other at an angle, at a good angle. This was probably a manipulation, faking going down, then it went all the way up. Then after here again, we had some sort of consolidation there. We said when the moving averages are sort of moving horizontal, it's not perfect horizontal, but when they are sort of moving horizontal, we don't take trades. We don't take trades. We are waiting for the moving averages to start dropping. That's when we start taking trades, or we want them to go up at an angle. That's where we take trades. So what I've just shown you is for the day traders. For the swing traders, how do we use moving averages? How do we use moving averages? Basically, what you want to do is again go to indicators and trend. These are the popular settings that people use. Let's change the weight of this, and we make that at 20. We'll start with at 20. You can make it at 21, but we'll start with at 20. So that will be our first filter. Now this is for swing trading. Let's turn it to 4 hour. This is for swing trading, where you're going to be holding your trades for quite some time. So we start with at 20. That's the short-term filter. That's our short-term filter, and we are going to add a 50. The 50 is popular whether with swing trading or with day trading. So with a 50 there is our 50, is the maroon one. You can simply see what's going on there. The 50 is definitely a popular with both traders. And there is also the 200. The 200. Sometimes people make it 250. Sometimes I need to change color here. Let's make it green. Let's make it green. The 200 or the 250, you can make it 250. Why do people make it 200 or 250? Because they then go to the daily time frame, because there are basically around 250 trading days in a year. So the 200 or the 250 moving average is very popular when you are looking at the daily chart. When you're looking at the daily chart, the 200 or the 250 moving average is a popular moving average. It basically gives you an idea of the long-term trend, the yearly trend. People also do use the 100. It's also popular. It's also a popular. Let's make it which color is not there yet. Let's make it the pink. The 100 is also used when it comes to the weekly and the daily. The weekly and the daily. So we are on a daily chart now. You can see with our 250 there, we've got our 100 there, and we've got our 50 there, and we've got our 20 there. Without a doubt, the trend has been up since last year, since 2020 May. This is Euro USD. You can easily tell from the moving averages that since May last year, price has been moving up. Since last year in May, price has been moving up. Now that we have seen price price dropping below these two moving averages, what you'll be watching out for is whether it's going to be dropping below the 100. Is it going to be defended at the 100, or is it going to drop further? Here we've seen that it comes, and usually when it drops, is defended at the 100. So that gives you a signal in combination with other things like your candlestick patterns and stuff. And from here, this is daily time frame from October. From October, you could have simply bought until January this year. From October last year, you could have simply entered a buy there and collected 631 pips easily. 631 pips easily without too much work. So same deal here, same deal around here. Here with a signal that things are changing, with our moving averages crossing the lower time frames, the lower moving averages, and our 100 was broken, and we definitely knew that we're up to something. There was 470 pips. This is on the daily, or maybe you want to drop down to the 4-hourly. You can still find your signals there. You can see price is getting defended at the 100 moving average there, and you can simply use the 50 and the 20 or the 21 to further filter when you can enter the trades, and especially when the moving the 200 or the 250 is broken, then you know it's a definite sell. And here price fell for you probably would have entered here, you would have collected your 142 pips easily. 142 pips easily. So you probably need to be targeting 100 pips each time this happens. Each time this happens, you want to target 100 pips, and you get out of the market and you see what the market will do. So this is a basic approach with moving averages. Obviously you would want to combine them with other indicators. Probably you want to use your support and resistance just to give you further confirmation of where price is going. But yeah, like this video if you found it helpful. If you've got questions that I can answer in future videos, subscribe if you're not yet subscribed. Until next time, bye.